On March 6, the Bank of International Settlements posted its quarterly review. Within this review, they posted a chart entitled Early Warning Indicators for Stress in Domestic Banking Systems. In this chart, they had a list of countries that were critiqued in 4 different categories. Credit to GDP gap, which examines how much debt the people of the country are taking on compared to the overall income of that country. Property price gap, which examines the deviations of house prices compared to long-term trends. Debt service ratio, which examines how much money people have available to pay off their debts compared to how much they owe. And finally, what the debt service ratio would be if interest rates were to rise by 250 basis points. Every 100 basis points equals 1%. Therefore, the Bank of International Settlements is figuring out what the new debt service ratio will be if everyone's interest rates were raised by 2.5%. And how did Canada do? We ended up getting major warnings in 3 categories, the only country on this list in that situation. That means that according to the Bank of International Settlements, Canadians have taken on a dangerous amount of debt, our housing is dangerously overvalued, and if the interest rates on our loans were to increase just 2.5%, it would cause serious damage to our economy. In an extract from page 28 of the quarterly review, they state that all 3 indicators suggest that the risk of banking strains remains elevated in a number of economies and regions. This in particular is the case for Canada, China, and Turkey, where the credit to GDP gaps are above 10%. They continue on, in the past, 2/3 of all readings above this threshold were followed by serious banking strains in the subsequent 3 years. That doesn't sound promising. As of December 2016, Canadians have taken on more debt than ever before, according to Stats Canada, owing on average $1.67 for every dollar they make on things like mortgages, credit cards, and other loans. It looks like Canadian banks may not be making the situation any better either, according to CBC's Go Public. In one article titled We're All Doing It, employees at Canada's 5 big banks speak out about pressure to dupe customers. A former financial services advisor from Calgary claims that his manager told him to attach high interest rates on mortgages and lines of credit and not to tell clients that those interest rates were negotiable. In another article titled We Do It Because Our Jobs Are at Stake, TD Bank employees admit to breaking the law for fear of being fired, a TD employee from Windsor, Ontario said that they increased people's lines of credit by a couple $1,000s just to get sales revenue points, and went as far as doing this without the customer's knowledge. At this point in time, these statements are only allegations and have yet to be investigated, but if this is true, it'll be another example of banks taking advantage of their customers for their own gain, like we saw in 2007, not only hurting average Canadians, but the country's economy as well. The major problem with taking on all this debt is that the cost of borrowing in Canada has never been cheaper, and an increase in the policy interest rate set by the Bank of Canada may not be too far away. If this happens, it could be financially devastating to Canadians who didn't know the risk involved in taking on debt at historically low interest rates. For those not familiar with the policy interest rate, the Bank of Canada carries out monetary policy by influencing short-term interest rates. It does this by raising and lowering the target for the overnight rate. The overnight rate is the interest rate at which major financial institutions borrow and lend one-day or overnight funds amongst themselves. The bank sets a target level for that rate. Changes in the target for the overnight rate influence other interest rates, such as those for consumer loans and mortgages. They can also affect the exchange rate of the Canadian dollar. In November 2000, the bank introduced a system of 8 fixed dates each year on which it announces whether or not it will change the policy interest rate. The policy interest rate is also known as the key interest rate. Currently, the rate is sitting at 0.5% and has been at this point since late 2015. Historically, the rate was much higher, sitting at 4.5% in 2007. You can see how this has affected commercial bank prime lending rates, which are currently around 2.7%, but were around 6% back in 2007. Since then, due to the financial crisis and the ensuing weaknesses in the economy, the central bank continuously lowered the interest rate to the point that it's at today. This was done to entice Canadians to spend more money and take on more debt rather than save, in order to get the economy moving again after the financial crisis. Clearly, Canadians did what the government intended, taking on more cheap debt than ever, but it hasn't resulted in the economic growth that the government was hoping for. According to Stats Canada, GDP growth, or the country's income, has been fluctuating from just under 0% at its lowest point to just above 1% at its highest point over the last 5 years, while debts are soaring. In the midst of all this, the end of low interest rate policies the government has been following for years may be coming sooner than we realize. Countries like the United States are starting to change their interest rate policies. Federal Reserve Chair Janet Yellen warned in February that waiting too long to remove accommodation would be unwise, potentially requiring committees within the Fed to eventually raise rates rapidly, which could risk disrupting financial markets and pushing the economy into a recession. If the US is starting to indicate changes in its low interest rate policies, Canada may not be too far behind. and this could mean years of financial ruin for Canadians who took on way more cheap debt than they could handle without understanding the consequences.